All right, so let's get started now. Can all of you guys see my screen and hear it fine?
Yeah, no issue.
All right, awesome. So today I'll be presenting about investing during high inflation. Of course, this is a pretty relevant topic, which everyone's been talking about recently. You had the CPI report last Friday, where inflation over the past year was reported to be 8.6%. And then just this Wednesday, the Federal Reserve increased its target rate by 0.75 basis points to 1.75% on the high end of their range. And then meanwhile, with the market, we've seen that go to record lows, with the S&P now down 23.7% from all-time highs. And then the NASDAQ down 33.4% from all-time highs as of this Friday. So with that background out of the way, this is kind of the agenda for today. I'll be covering inflation and what the Federal Reserve is doing to combat it, whether inflation can be brought down, different investments for inflationary times, and how to control emotions during a market crash like the one we're in right now. If you have any questions along the way, feel free to drop those in the chat and I'll try to get to them. Well, otherwise, we'll also have a Q&A session at the end for any other questions like that. So before moving forward, I kind of want everyone to post in the chat something you know about inflation or any of the topics on the slide. This could be as simple as gas prices are going up or as advanced as you know, to kind of get our minds in the topic and see where we're all at. So if you guys could all post something in the chat that you know about inflation, that'd be great. I'll give you guys about 2 minutes to do that. All right, so we have some good thoughts coming in the chat. One thing someone said, groceries cost more now, for sure. Value of money decreases. Yes, everything is getting more expensive now. The rate of price rise is more than income rise. That's an important one. Essentially, you're actually getting a pay cut. College tuition is going up. Yep. Airline fares as well. Also, you can post anything outside of inflation as well. For example, different investments for inflationary times. Any of these topics, if you have any thoughts, just post those in the chat. Dipping into savings, rents and housing prices as well. All right, so quite a few good thoughts in the chat. We won't get to cover all of those things today, but we'll kind of go over an overview of where inflation is right now, what the Federal Reserve is doing to respond to that, and a couple of other things like what investments could work well in this time and how to control your emotions during a crash. So before we start, I want to quickly introduce myself. My name is Vanil. I'm from the Seattle, Washington area, and I'm an upcoming senior at Eastlake High School. I actually started learning about investing at the age of 8, and I bought my first stock at the age of 11. I've been teaching investing to teens and adults for the past 3 years, and I've also built up a successful school investment club during that time. And lastly, over the past 5 years since I started investing, I've been able to more than double my money in the stock market. All right, so now getting started, I want to start with an overview of inflation over the past year and a half. Obviously, as a lot of you guys mentioned in the chat, it's really, really high right now, but the trend is actually pretty interesting. So on the slide, you have 4 charts. On the far left is overall inflation, then inflation in food, inflation in energy, and core inflation, excluding food and energy on the very right. So back in the beginning of 2021, inflation was well below 2%. And this kind of makes sense because inflation is a change in price year over year. So in January and February of 2021, we were comparing to pre-COVID levels in January and February of 2020. So those inflation numbers were kind of low. And then inflation then increased significantly to around 5% in March, April, and May, as we're comparing to COVID lows in the economy. Then things were kind of becoming steady until the end of 2021, when inflation unexpectedly went higher again to almost 7%, at which point the Federal Reserve started hinting at action to bring those numbers down. And in recent months, inflation has continued to persist at rates higher than, to be honest, nobody was imagining, which has led the Fed to consider even more drastic action and of recent, an even fiercer downturn in the market. What's interesting in food is that food inflation was lower than overall inflation in mid-2021, and that's since caught up and gone way above overall inflation to 10.1% in the most recent CPI report. So quite a few people were mentioning groceries and food, and kind of really seeing that start to hit in the past couple of months as this food inflation has really overtook other different goods. Then in energy, what started as deflation in January of 2021 has now turned into a 34% spike as a result of lowered supply and surging demand for oil. A lot of people can see that in your gas prices, which are in many states above $5 a gallon now. And that's been pretty stable for most of the year, but it really spiked up in March. And then finally, with core inflation, this has also gone up significantly, but it's actually moderated in recent months, which is coming down to 6% as of May. And so overall, a bunch of factors have kind of pushed us to 40-year highs in inflation, and it's really affecting every single category across the board. The funny thing, though, is that analysts have been pretty much dead wrong about this inflation. On the left is an inflation forecast from a Bloomberg article, which was published on January 11th, 2022. In January, inflation was expected to reach highs just above 7% and then come down to 4 to 5% by mid-2022. People are expecting inflation to kind of moderate, especially after April and May, because then you'll be comparing to prices at a higher base from April and May of 2021, which were already well above pre-pandemic levels. But to most people's shock, inflation continued to persist, going to 7.9% in February. And so all these analysts and all their estimates, of course, were revised upwards. People are starting to predict more inflation. And so on the right, you also have an article from Fortune showing the estimates of an investment bank called UBS. And just about a couple of months after this January estimates, these estimates were pushed quite a bit higher. And so they got the 8.5% for March correct, but now we're at 8.6% for May instead of the 7.2% that was forecasted. So now we're even higher than what they were forecasting in April 7th, 2022. Now, of course, estimates by these analysts are way higher, and the Fed themselves is expecting 5.2% inflation by the end of 2022, up from the 4.3% it was projecting in March. And so this unexpectedly high inflation, which has pretty much continually blown past estimates for the past year and a half, has put a lot of pressure on the Federal Reserve to bring this inflation under control. And the Fed, to its credit, has taken significant action and plans to take even more in the coming months to bring this down. And it has two primary tools to make that happen.
Interesting. You have to learn.
So before we move on to kind of the Federal Reserve and what they're doing to bring this inflation down, does anyone know what the Fed wants inflation to be at? So right now we're at 8.6%. Where does the Fed kind of want inflation to be at? What's like a good inflation level for the economy as a whole? You can feel free to put that in the chat or unmute your mic. All right, so a lot of people are saying 2%, 3 to 4%, 2%. And yeah, that's exactly spot on. The Fed, they really want like 2 to 3% inflation, intuitive, but really slight inflation is pretty good for the economy. So obviously we're way above that, and the Fed kind of wants to bring that down to the 1, 2, 3, 4, 5, 1, 2, 3, 4% range, preferably closer to 2%. Someone asked, how exactly is 8.6% calculated if you see all items are way more than 30% up? So yeah, the Fed has their own method of calculating CPI. This is CPI inflation, the consumer price index. Obviously, a lot of the stuff you see at home are probably up 30% or more, like you mentioned. So this is kind of like the Fed's way of doing it, and it might be a bit lower, but this is really the only number we have to track. So yeah, so now moving on to the Federal Reserve's response. Really the first tool that they use to kind of curb inflation is what's known as rate hikes. So the Federal Reserve controls the federal funds rate, or FFR for short, which is kind of a target range for the interest rate at which banks borrow money from one another after the business day ends to maintain the reserve requirements that they're required to have at the Federal Reserve. And although banks aren't forced to lend or borrow at the target, the Fed can take action to influence it if rates aren't near the target. So in essence, the Fed has a direct handle on this federal funds rate. And the thing is, when this rate of overnight borrowing changes, it changes the cost of operating for banks, which causes a ripple effect on other interest rates. For example, if the FFR goes to zero, like it did in March of 2020, banks can borrow for almost nothing and can therefore lend at a lower rate while maintaining the same profit margins. And they're forced to go lower in order to stay competitive. And so the 0% federal funds rate indirectly influences the rates for other things like savings accounts, credit cards, and mortgages. And you also have interest rates for corporate and treasury bonds, which are essentially loans to companies and the US government, which also end up going lower because the bond market has to adjust to this new environment of low rates, which was set by the banks. And so in other words, people are willing to lend to companies and governments at a lower rate because they can't get anything better in something like a savings account, which now pays much lower, in fact, close to zero when the rate went to zero. So with pretty much all short-term rates down, this makes borrowing cheap, increases spending, and stimulates the economy when the economy needs some help after COVID happened in March. And so using this rate cut, the Fed was essentially able to push the economy up just through this rate hike, because it basically spiraled into all the different rates that people use. Now, it's important to note that changes in the FFR strongly influence short-term rates for the previously mentioned reasons, but they don't influence long-term rates as much because in a period of 10, 20, or 30 years, the economic situation and federal funds rate could look different. For example, this chart from the Federal Reserve Bank of St. Louis shows the federal funds rate in blue, which the Fed controls essentially, the interest rate for a 1-year loan to the US government in red, and the interest rate for a 10-year loan to the US government in green. And so while the short-term treasury rate, which is in the red, has pretty much exactly tracked the FFR in blue, the long-term rate in green has had far less movement that's in tandem. And so there's still been a noticeable amount, but the long-term rates are less influenced by the federal funds rate because there's such a big time horizon in which the economic situation could change going forward. Now, kind of getting back into the current situation, the Federal Reserve is raising the federal funds rate at a rapid pace to control inflation. Just this Wednesday, for example, they raised it by 0.75 basis points to 1.75% on the high end of their range, which is up from just 0% just a couple of months back. On the graph to the left, the blue lines on the graph represent the median forecast of the Federal Reserve members for the federal funds rate in 2022, 2023, and 2024. So currently the rate is at 1.75% on the high end, which was up from 0% just a couple of months ago. And they're forecasting, or essentially the Federal Reserve members are saying that they think that the rates can double from here to 3.5% by around 2020, end of 2022, and stay that way for the next 2 or 3 years. And so what impact this has is that these higher rates, opposite to what happened during COVID, cause a higher cost of borrowing. People have to pay more interest in order to borrow money, whether it's through their credit cards, for mortgages, for bonds, or debt, any other debt in general. And so this leads to less spending and no more easy funding for companies, which further leads to a slowdown in company profits, the general economy, and therefore inflation, as companies can't increase their prices as much when the demand is falling. And so rate hikes kind of is like a very powerful tool the Fed has in order to curb demand, curb spending, and tweak inflation the way it wants it to go. Now, the second tool the Fed has to combat inflation is what's known as quantitative tightening, or QT. If you thought Apple's assets of $350 billion was large, the Federal Reserve has a whopping $8.5 trillion in assets. And 2/3 of that is in government bonds, and another 1/4 is in agency bonds and mortgage-backed securities. And so using this massive portfolio, they can control interest rates further on top of what they're doing with the rate hikes, using the portfolio of bonds that they hold. So during what's known as quantitative easing, or QE, the Fed kind of does the opposite of QT, which is printing money and using it to buy bonds, aka increasing the demand for lending. And that demand pushes interest rates lower in the favor of the borrower and encourages spending, because the supply of the borrowers is the same and they're increasing the demand of lending. And so this is what happened on a very, very large scale in 2020, which you can see to the image to the right. The Fed printed almost $5 trillion. Now, though, the Fed is considering what's known as QT, which is the exact opposite of QE. The Fed sells bonds, aka reducing the demand for lending, causing interest rates to go up in favor of the lender and discouraging spending. And so in QE, you had the Fed buying bonds to increase demand for lending. And in QT, you have the Fed selling bonds to reduce demand for lending. And this allows them to kind of change interest rates to either encourage or discourage spending based on where they want it to go. And so in some ways, the QE and QT, aka injecting and retiring money from the market, has the same effect as the federal funds rate hikes, which is changing interest rates. The big difference is that QT has a more gradual effect as the Fed sells their bonds. So it's kind of like something they employ in the background while using rate hikes as a primary mechanism to curb inflation. And so usually you'll see these two both being used in tandem. The Fed officially started QT on June 1st. So they're currently selling $47.5 billion a month in assets, and they'll continue doing so until September 1st, at which point the pace of selling increases to $95 billion a month. And as you can see in the chart to the left, at a pace of around $100 billion a month, which is the red dotted line, the Fed would retire all the money it printed and inject it into the market by around 2026. That is, if they continue QT for that long. So are they actually selling or letting it mature, i.e. run off? So the Federal Reserve, they're actually selling those bonds. They're increasing the demand for selling. They're increasing selling pressure. And they kind of retire that money from the market. It doesn't evaporate, but they kind of hold it. They might give it back to the government, but they take it out of the market and increase selling pressure, which in turn increases rates in the bond market. And so overall, with rate hikes plus quantitative tightening, the Federal Reserve has two powerful tools to control inflation. For example, the recent moves the Fed has made, they've increased rates to 1.75% on the high end, and they're starting QT at $47.5 billion a month, plus the plan to significantly boost both of these things in the coming months. A lot of people are thinking that this will cause a recession. So a recession happens when you have 2 consecutive quarters of economic decline. And since the Fed actions are slowing down spending, although this helps cool down inflation, it also inherently means the economy is going to take a hit. So right now we're already past 1/4 of economic decline. So an increasing number of people think that a recession is likely, which in turn causes stock prices to go down as people price in less profits for companies. And so the Fed's actions, they're kind of forced to do it to combat this high inflation, and that inherently kind of threatens this recession and forces the stock market lower into the sort of downtrend that we're seeing right now. So do you have any questions about rate hikes or QT and how the Fed controls inflation using these tools? We have a question saying, who would be buying these bonds sold by the Fed? This would be people in the market, people who would generally be buying bonds. For example, yeah, companies and governments, and just regular people. The public actually owns, in the US, the public owns the majority of national debt. So is BND a safe place right now as interest rates are going up? So that's actually a question we're going to answer in a couple of slides from now, different investments for an inflationary time. Yeah, bonds are pretty stable. They're doing pretty well right now. So who has money to buy so much bonds? Exactly. The supply hasn't really changed for people who are interested in buying bonds. So the selling pressure is causing the price of these bonds to go down because there's the same number of buyers and there's increasing selling. So that's exactly what causes the supply demand shift to cause the prices to go lower and increase the rates. Where it is more gradual though, because the Fed, they're not, laying off trillions at once. It's kind of like they're being very measured in terms of like $50 billion every single month. All right, so if there's no more questions about this, we'll get into our next segment, which is, can inflation be brought down? So although the Fed is pulling all of its levers on inflation to lower it down, there have been concerns about whether hiking rates to high enough levels is possible given the United States' massive $30 trillion in national debt. So when the Fed raises rates, new bond issues, especially short-term ones, are at a higher interest rate for reasons we talked about previously. And so the US has to make higher interest payments on that debt. The issue comes on whether the US can afford the higher interest payments that come with rate hikes without having massive deficits, which require the printing of more money. And so to give some context on how much the US spends on interest, the US had a net interest outflow, aka interest paid minus interest earned, of $40 billion in May of 2019, which is about $480 billion in expenses annualized. And that monthly number fell to $26 billion when COVID hit, then went up to $37 billion in May of 2021, and up to $56 billion most recently as of May of 2022, which represents about $672 billion annualized, with the federal funds rate at just 1% at the high end. So this brings the question of what federal funds rate is needed to curb inflation from the current 8% to around the 2.5% that we were talking about earlier is kind of where the Fed wants to be. And then whether the government can afford to do that. And so you have something called the Taylor rule, which is a famous formula from a 1993 paper. And based on that, the federal funds rate might need to be close to 4.5% based on a 0.03% output gap. The formula looks kind of fancy, but it's essentially a way to derive the federal funds rate that the government, the Federal Reserve needs to use to control inflation to a certain level based on how overextended the economy is. And so if you just plug all those values into this formula, you'll get around 4.5% to bring 8% down to 2.5%. But even if you disregard this number completely, the members of the Federal Reserve themselves expect to have rates near 4% by the end of 2023. which is far, far higher than the 1% at which the US already has $56 billion in net interest outflows. So obviously the situation kind of looks really bad, whether the US can afford all these rate hikes, which are needed to curb inflation. But I'll go ahead and say that despite this, it's probably likely that the Fed can pull it off, whatever is needed to control inflation without too much of a problem in terms of interest payments. And the main reason for that is because the higher interest debt only applies to new issues and not on existing debt, which gives some time before interest payments seriously pick up. And then on top of that, the budget deficit has shrunk substantially from last year. So the US may be able to afford the interest without causing further inflation. Really, right now, the market is pricing in that rate hikes go through and inflation eventually cools down. So the question is kind of more about how fast inflation can be brought down, more so than if it can be brought down. Currently, for example, the projections are 5 to 6% by the end of 2022, 3% for 2023, and 2% for 2024. And these forecasts, like the previous ones from the past year, are probably off, and they'll keep on adjusting as the Fed announces certain rate hikes, a certain pace of quantitative tightening, or one of a bunch of other factors which impact inflation. So I want to emphasize that trying to predict future inflation and other macro events is really a fool's game. Nobody has any idea for sure where it's going to go. So trying to make short-term trades based on these sort of events probably won't end well. And then also all the data regarding the inflows and outflows of the federal government, these are all available at the link. Let me actually post this in the chat. They have some really nice diagrams and stuff, which will give you some full transparency into kind of where the money of the US government is going to. So if you're interested in that, I just posted that link in the chat right now. All right, so if the federal funds rate and short-term treasury go to 4.5%, the 10-year is likely to go near 5% to 6%. Probably not, I wouldn't think so. It'll probably go upwards, but not as much as the FFR would go up, mainly because of the graph we talked about earlier. Let me quickly go back to that graph. So right here, this graph right here, the 10-year, it kind of follows the pattern of the FFR, but it's a bit more muted. So if this goes up from right here around close to 1% all the way up to 4%, the 10-year treasury would probably go up, but not, I wouldn't say close to 5 to 6%. So how useful is the Taylor rule? It's kind of like a theoretical formula. So I believe the person who made it was like a Stanford economist. He was like an advisor for one of the previous presidential administration's economic advisor. So he kind of just made that as a model for what the Federal Reserve should do in terms of its policy. It seems like the Federal Reserve members are pretty close to there in terms of 4.5%. So the short term is 4.5%, then 10-year will be greater than 4.5%, unless the yield curve is inverted. Yep, the 10-year treasury will probably go up. I don't know if it'll go up 3%, but it'll definitely go up if once the federal funds rate gets to 4.5%. All right, so the next segment is about in long-term investments for inflationary times. But before getting into it, I want to show this image that kind of sums up the power of investing and what happens if you don't invest it, especially when inflation is high. So I want you guys to guess how much $1 in 1800 would be worth today if you invested it in stocks, bonds, gold, or kept it laying around. So we'll start with stocks. What do you guys think that $1 in 1800 is worth now, inflation adjusted, if you invested it in the stock market? Any guesses in the chat? We have 1,000. Any other guesses? 1 million? So a couple people think a million. All right, so quite a few guesses. The real number, let's go back here. Looks like these aren't working. Let me push this to the side. So the real number is $1.4 million. So $1 in stocks is now $1.4 million since 1800, inflation adjusted. So that's quite a bit. Any guesses for bonds? $10,000? $50K, $500K? All right, so the actual number is $15.99. So miles below what you had in stocks. And then just the gold went to $3.09, so only about a 3x inflation adjusted. And then if you just left it be, the power of the dollar has eroded quite a bit from $1 down to 4.8 cents. So stocks have absolutely crushed it. Bonds pretty good. Gold, not bad. And if you just kept it around, you would not be doing so well. All right, so now getting into the different investments for inflationary times, I've divided this table up into two different buckets. So on the left, whether you think high inflation will stay for more than 3 years, and then on the right, whether you think inflation will normalize after 3 years. And all of these investments will do well over a long period of time, regardless of where inflation goes, but some will do better than others depending on the macro environment. And so for the high inflation category, the best investment you can make by far right now is into what are known as I-bonds. I-bonds allow you to loan money to the US government, which then earns interest at a rate which changes every 6 months based on CPI inflation. So currently that rate is at the insanely high number of 9.62%. And that return is essentially risk-free because there's no volatility and the US has never defaulted on its debt. The tax treatment is also pretty favorable because all the taxes on interest is deferred until your money is paid back. And it's also exempt from state and local taxes. But there's also quite a few catches as well. The biggest of which is that you can only invest $10,000 per social security number, meaning you probably can't dump all of your savings into this investment. The other thing is that you have to hold it for at least a year. And if you don't hold it for at least 5 years, you lose the last 3 months of interest. The taxes on interest, while deferred, are also at the income tax rates, which are generally higher than what you'd pay for a long-term stock investment. And then the last thing is that the interest rate won't stay at 9% forever, actually just for 6 months. So the return will probably be pretty lower when inflation eventually cools down to lower amounts. Still, hypothetically, if you were to make an investment into an I-bond and withdraw your money after a year, you could still easily earn a nice 6 to 7% return pre-tax with pretty much zero risk. So the second set of investments you could consider for high inflation are treasuries and treasury inflation protected securities. The former is essentially regular government bonds. You're lending money to the federal government in exchange for interest, which is around 3.5% right now for a 10-year period. And the latter, which is called TIPS for short, pay you based on inflation similar to I-bonds. They compensate you in amount matching the inflation rate, plus offer additional interest payments, which are about 0.5% right now for a 5-year period. They do have an investment limit of $5 million, which most people won't reach, but they aren't nearly as good as I-bonds because if inflation goes down all of a sudden and you want to withdraw your money, the value of the bond will be lower and you'd lose a portion of your principal. And so while I-bonds are pretty much risk-free, you can withdraw and you only lose part of your interest. With TIPS, it's way more risky because if inflation goes down and you want to withdraw, you could actually lose quite a bit of money. And so tips, while they protect your money, if you don't plan to hold it for a while, that could cause a bit of trouble if you end up trying to sell that. And the last one for high inflation you have are REITs, or real estate investment trusts. These are essentially companies that trade like stocks, but their whole business model is buying property, renting it out, and paying the rent back to shareholders who invest in the company. And historically, these REITs have performed well during inflationary times since they can increase the rents they charge. And even outside of inflationary times, they tend to perform quite well. You also have things like commodities like crude oil, but I haven't listed them on here because they aren't really long-term investments. You wouldn't hold, for example, you wouldn't hold oil or other commodity stocks for the short term or the long term without making a gamble on where the underlying commodity will go. And so I've kind of kept that out of this table for now. So a couple of questions. How much do tips yield right now? It's about 0.5% for 5 years. But then again, it's 0.5% plus inflation. So your principal actually increases by the amount inflation is. So you're getting a 0.5% real yield. You're going to get 0.5% after inflation, no matter what inflation is going to be over the next 5 years. And then I bonds are only for citizens, as far as I know. Yep, I believe so. You have to have a social security number. Citizens, I'm not sure if permanent residents are also included, but that's something you could probably search up and check on that. All right, so then on the right side, we have the one investment for the situation in which inflation ends up normalizing, and that is stocks or pieces of a company, and then index funds, which are a piece of a basket of different companies. So even in the unlikely event that high inflation still lingers over 5 years, stocks will perform well if you have a long-term time horizon of more than 10 years. And so me personally, in the current environment, I'm putting all my capital to stocks and index funds, which are down almost 24% and present a once in a 5 year buying opportunity. But this is also money that I'm tucking away for 20 plus years and won't be needing anytime soon. And so if you need your money in the next 5 years, definitely don't invest that in stocks. Consider something really safe like I bonds or treasuries or some other pretty risk-free investment. And then I think I bonds as a temporary investment while inflation is high, and REITs as a long-term investment work pretty great. I would generally avoid any other bonds like treasuries and tips, mostly because low single-digit returns simply won't cut it in terms of building wealth over a long period of time and being able to retire comfortably. And so if treasury rates eventually go up to 6%, then it could be something that could be more interesting depending on where the inflation rate's at. If inflation ends up going lower and treasuries are at 6%, that could present a more compelling opportunity. But right now, where they're at around 3%, it really wouldn't cut it in terms of building wealth over a long period of time. And so I would recommend instead going with I bonds, REITs, or any of the other investments on here. All right, so it's anybody with the social security number in terms of I bonds. Thanks for clarifying that. What is the time horizon for REITs to get a good return? I would say the same as stocks. You want to be at least 5 years. REITs can also be pretty volatile. They trade just like stocks. They can also go down 50%, like they did in COVID. So you kind of want to have the same time horizon as stocks, mainly long term. But over the past 50 years or so, REITs have averaged about 12% annually, which is actually beaten out stocks. So they've historically performed quite well, and they'll be a good option. You'll also get paid nice dividends and stuff like that. So how do commodities perform in a high inflation environment? It's tough to say. Really depends on the commodity. For example, right now, lumber prices are going, sinking down right now, whereas you have oil prices pretty high. They can perform relatively well depending on what you choose. The real issue I have with commodities is that they're not exactly a long-term investment. For example, you saw in gold, just $1 in 1800 is only $3 now. So you're not really getting a great return over a long period of time. Commodities haven't really changed drastically over the past 100 years, over the past 20 years, over the past 10 years. And so in terms of building wealth, retiring early, being able to have a financially stable, independent life, I wouldn't say commodities would be the best place to go right now, especially when you have I bonds where you can pretty much guarantee a 6 to 7% return for the next year or so. And then we also have, how about investing in crypto? I think crypto, if you are interested in it, I would limit to 1 to 2%, 1 to 3% of your portfolio. As we've seen recently, cryptocurrency is very volatile. It went up and now it's coming all the way back down. Bitcoin's now under $20,000 as of today. And so crypto is something where there's a chance it could go, way higher in the future, but you also have a lot of headaches like government regulation. It could also go to zero potentially. And so really, I wouldn't bet a large portion of your portfolio on crypto. If you're interested in it, put a small portion of your money into it. 1 to 3% of your portfolio, maybe less. But I wouldn't go more than that just because it's so volatile and so risky in terms of. Yep, income ETFs, that's also a great one as well. Things like JEPI, there's also another one called NUSI. These are more stable than stocks, but they also have pretty nice yields as well. Do we also have any questions about any other questions about these investments? What about leveraged ETFs like SQQQ? Personally, I would avoid leveraged ETFs. Really, I would just go into high quality stocks, index funds, I bonds, or REITs. These are really proven ways to make money over a long period of time. There are interesting options. For example, you have UPRO, which is a leveraged S&P 500 ETF. The thing is, it goes up a lot more, but when it comes down, it really comes down hard. And they're not also like super efficient, so you could lose a lot of returns. It's not exactly 2x or exactly 3x, or the opposite way on the short side. And so if you do end up putting into leveraged ETFs, I would recommend not having that as the entire portion of your portfolio. Have some safer investments as well to kind of reduce the volatility of your portfolio. But I think leveraged ETFs on the bullish side for different index funds could be an interesting way to play it on top of some other investments as well. Yeah, leveraged instruments are also pretty much usually used for trading, short-term trading, as opposed to long-term investing, mostly because of the inefficiencies. You won't exactly get 2 or 3x over a period of 5 or 10 years. And you're also taking on a lot more risk, of course. So thoughts on international markets right now. I think having international is not a bad idea. Obviously, over the past 10 years, the US market has dramatically outperformed the international market, but there's been decades in history where international outperforms, decades when the US outperforms. And so having diversity in that respect isn't a bad idea. But I would also keep in mind that US companies, a lot of their revenue also comes from other countries. So a lot of foreign diversification isn't necessarily needed, but if you think it's a good place to put money, I would put it there. But I'll be very careful about where you put money because there's quite a few markets where the stock market hasn't done very well over a long period of time. For example, in Europe, or if you look at Japan, the overall market there hasn't really done much for a while. So be pretty careful about where you put it there, but it's not a bad idea to geographically diversify into different companies if that's something you're interested in. But again, I want to emphasize that trying to predict whether international or US will outperform over the next 10 years is probably a fool's gamble. It's not worth playing. I'll just kind of keep steady and keep a steady allocation in terms of what you want to do. All right, so now finally, I want to get into our last segment, which is on emotional control, which I'd say is more important than ever right now when the market is down massively and fear is rampant. For example, the CNN Fear and Greed Index is in extreme fear territory right now at 14, and it's been in fear territory for pretty much the majority of the past year or year and a half. And so the biggest mistakes that most beginner investors make is related to mindset. In these types of moments when the market is down so much, it's crucial to keep a long-term mindset and not be swayed because the market is going in a certain direction or not going in a certain direction. And so here I've kind of assembled 3 different tips or thoughts to consider in terms of keeping your emotions under control. The first of these is taking comfort in history. So downturns never last forever. In the past 150 years, the stock market has always returned after dropping and has gone towards all-time highs. And this usually happens fairly quickly. Does anyone know the longest time the market was in the red for? Like the longest time period in the last 150 years where you could have invested something and not made any money? If anyone knows that, feel free to drop that in the chat. Yeah, so it's around 15 years. It happened during the Great Depression, from around 1930 to 1945 before you saw a positive return. But that was the longest time. And so the average bear market actually lasts only about 9 months, while the average bull market lasts about 3 years. Even, if we have an extreme situation, it's unlikely that you'll be losing money over a 10+ year time period. And so really, I would really say take comfort in history, and know that eventually, potentially fairly quickly, the stock market will reach new highs. You won't be down here forever. You won't be down here for a long period of time. My second tip or thing to consider is to view stocks as businesses rather than as fluctuating prices. So when you see different stocks down 20, 30, 40, 50%, it's easy to get tied up into the prices and where the stock is going, and kind of associate value with that. But I would really emphasize thinking of stocks as businesses, things that are selling goods, selling products, selling services, making money, having expenses, and then having profits, some of which they share back to their shareholders. And if you really have that mindset, it becomes easier to stomach, because you're looking at the actual money coming in, the actual profits, which aren't as much down as are the stock prices. And the last thing I would definitely consider is to set up automatic investments into an index fund and then completely forget about the market. To be honest, this is the easiest way to build wealth over a long period of time. An index fund, for those of you guys who don't know, is essentially a group of different companies that are all bundled up into one investment. So you can kind of get a piece of the entire US stock market with just one investment. And pretty much all brokers these days, they offer automatic investments. So you can literally take a portion of your paycheck and automatically send that into the S&P 500 every single month. And pretty much don't even worry about the market and then wake up 20 years later and see how much, the probably largest sum of money you have laying there. And so if you're kind of can't keep your emotions under control, or you want a simple way to build wealth, I would seriously recommend kind of setting up these automatic investments and really forgetting about it. That's really a great way to not be worried about these sort of downturns. All right, so some comments in the chat. There's some non-zero chance that we could be in a similar pattern as 1965 and 1982. And the S&P 500 took 10 years to recover from the dot-com burst. Yep, that's completely true. We could have 10 years from now until 2032, where the stock market really does nothing. But for anybody who has a long-term mindset, like a really 20+ year mindset in terms of building wealth, usually the 10 years after the 10 years of doing nothing will be a pretty powerful 10 years. And so if you're in the market for multiple decades, the next 10 years not doing much really isn't a worry, because you're kind of thinking in multiple decades rather than a single decade. But if you do need the money in the next 10 years, you're close to retirement, maybe the stock market isn't the best place to keep your funds. You might want to consider I bonds for some cash. You might want to consider treasuries, tips, and other safer investments if you need that money at a shorter term. Yep, exactly. If you're in your 60s and 70s, it could be risky. All right, so before we get into the Q&A, I want to talk about a summer investing workshop that I'm conducting next week through my company, InvEssential. Generally, investing can be a pretty difficult topic to grasp on your own, and also isn't taught in most school systems, which is why I'm teaching the 7-day workshop for beginners and teenagers. And I highly recommend you register for the following reasons. I'd say that this presentation was probably on the advanced end, but in the workshop, we start with the absolute fundamentals and work our way up to more advanced topics. Each of our 7 sessions are 1.5 hours long, and we'll spend time understanding and going through in depth many important investing concepts, as well as things like taxes. We conduct everything through Microsoft Teams, and we'll also have different assignments, quizzes, and tests, as well as optional homework to reinforce learning. Our entire thing is $50, which is about $5 or $7 per class or per session. So it's a pretty great deal considering how much lower this is than other classes out there. And we also donate all the profits to the World Wildlife Fund, which works on conservation and other environmental work. And so how do you register? You can register and learn more information about the course at our website, investential.com/summer workshop. I'll keep in mind that registration closes tomorrow night at 8 p.m. Pacific time. So you'll have to sign up pretty soon. And if you have any questions about it, you could contact us by emailing investentialhelp@gmail.com or calling 425-395-9771. So if you're a beginner or someone or a teenager or someone who's looking to learn more about the stock market, I highly recommend coming and joining this interactive course, interactive 7-day workshop that we're doing next week. Yeah, the link, I'll drop that in the chat as well. So yeah, that brings us to the end of this session. I want to do a Q&A as well. So if you can ask me anything about what we covered or about the summer workshop, and I'll try to answer those questions to the best of my ability. Let me also post that link in the chat right now. So any questions, feel free to drop those in the chat or unmute your mic. All right, so there's one question I missed up there. Which indexes do you suggest? I would say the S&P 500 is really what I'd say for most people is right. The S&P 500 is essentially a group of the top 500 companies in the US. And over the past 150 years, it's averaged about 10% return annually. For context, that's about $10,000 into 1.2 million over 50 years. So it's a really solid one that's historically done very well. There's quite a few funds that allow you to invest in that. For example, I'll drop a few tickers in the chat. You have VOO, which is an ETF. You could also do VFIAX. You could do FXAIX, and you also have IVV. I'll say these are the top 4 tickers in terms of getting into the S&P 500, low fees and everything, these are pretty much available through all brokers. Question about when the market's going sideways, is it worth investing in index every month? Yeah, I think dollar cost averaging is a great strategy. And it kind of happens automatically if you're investing a portion of your paycheck every single month. That'll automatically be dollar cost averaging, essentially investing no matter where the price is at every single month. Even if the market's going sideways, if you have a 20+ year horizon, that investing every single month will really pan out after that end. But again, if you have a short-term horizon, I wouldn't consider investing in an index fund. So there are times in the past when the market went to single digits. If so, we could go under 2,000 on the S&P 500. Long way to go. Yeah, if it really gets down to that, it's possible. But so yeah, I would emphasize that if you need your money over the next 5 years, there's plenty of other investments to consider, like TIPS, treasuries, and I-bonds. Does interest rate for Series I savings bonds keep changing as Fed changes interest rates? Yes. Currently, it's 9.62%, which is which was done in May, and that lasts in March, or it might be April as well, and then it goes all the way until October. And so that interest rate of 9.62% is there until October, and then after that, they adjust it based on the inflation rate at that time. You'll get a new rate for the next 6 months, which will probably be lower than what it is right now. or it could be pretty similar, but it does change every semi-annually, so twice a year. Please list those suggested index in the chat window. Yeah, I put, if you scroll up, I have some tickers, VOO, VFIX. If you scroll up a bit, you'll find those. Thank you guys all for the compliments. How often we can invest in iBonds? You can invest whenever you want, but the max cap is $10,000 per social security number. But if you're like a family of 4, then you could add up, you could multiply that by 4. So you could really put in $40,000 every single year into iBonds. So there's annual, so like over 10 years, you could put in $400,000 if you have a family of 4 and you always contribute the maximum. There's also a little trick. I think you can also do an additional 5,000 on top of the 10,000. If you use your tax refund, you can also do $15,000 a year if you really want to invest that badly. Yep, and there's a $100 minimum as well. All right, so I think that's most of the questions. Again, the link to the workshop, which is taking place next week, is in the chat. It's also at investcentral.com/summer workshop. And registration for that ends tonight. Tomorrow night. Yeah, if we have any other questions, I'll keep this call going and answer any other stuff we have. All right, so for automatic investments, beginning of month or end of month or middle of month better. I think there's probably some sort of research study out there that has analysis of this, but to be honest, I think it really doesn't matter. I would do whatever's most convenient to you. If I want to do automatic, which day is better? To keep it simple, I would just say the first Monday of each month. If you want to keep it simple, there's no numbers behind that, just something random. But there's probably, if there is any difference between what day or what month, what time of the month you set up automatic investments, it's probably very, very small. The market's quite efficient, so if there really was such a pattern, people would take advantage of it pretty easily. So I really would say anytime that's most convenient for you. Well, actually, I guess one more thing I would say, as soon as your paycheck comes in, like for example, if your paycheck comes in on Mondays, I would do it on Monday. If it comes in on Tuesdays, I would do it on Tuesdays. Like I wouldn't wait like a month after your paycheck comes and then invest it afterwards, mostly because the market over most of the time is up more days than not. So you might gain a slight bit by doing it as soon as possible. So if kids are going to college in the next 3 to 4 years, which investment option is good given the current situation? Yeah, I'll definitely say stocks and index funds. Now is actually a perfect opportunity to learn more, go deep into this, and start investing. Because right now you have the market down 24%, which is kind of like a 1 in a 5-year opportunity. I think the last time the S&P was down this much was in 2018. Before that, you'd have to go down to 2011. And so if you're not yet in college, 100% stocks and index funds, or you could also go into real estate investment trusts, will be the way to go right now. And even if the stock market doesn't do anything over the next 10 years, you'll still be fine by the time you retire. But yeah, additionally, if you're 3 to 4 years from college, definitely don't go into bonds. 100% don't go into treasuries or stuff like that, because those are pretty low yielding compared to stocks over a long period of time. Which are good real estate investment trusts? There's quite a few you could go into. There's a classic one that a lot of dividend investors like, which is called Realty Income. The ticker symbol is just the letter O. This is a pretty popular one. They invest in residential properties. They pay you about 4.5% of your money back every single year. There's also a ton of others. I can provide some tickers. There's STOR, Stored Capital. You have WPC. WPC is a very diversified REIT. They have industrial properties, residential properties, agricultural properties, and other stuff. You also have American AMT. These guys are in telecom and telecom infrastructure. If you really search up any sort of industry, you can find a bunch of real estate companies that provide properties for that. There's also some that are in cannabis, different industries, manufacturing, agriculture. You could really do it for anything. Some of the ones that have gone up a lot recently are some of the data center related things. So real estate for data structure, infrastructure, which is obviously in high demand right now. There's also index funds of real estate investment trusts like VNQ. These are kind of groups of real estate investment trusts. That could also be a good option if you don't want to choose specific ones to pick. I may have missed one question up here. What caused the sudden rise in inflation? The answer to that would give the solution probably. Yeah, I think demand has just gone up so much, and a lot of that is because of the action the Fed had to take in COVID. And so once COVID hit in March of 2020, the Federal Reserve printed $5 trillion in QE, and on top of that, the national government, printed even more money to support a bunch of different packages that they were passing at the time. And so they printed about like almost $10 trillion added to the money supply. And they also gave out stimulus checks, a bunch of other stuff like that, which essentially gave a ton of money for people to go and spend, which when COVID first hit, that helped prop the economy up. But then quite quickly, the demand from after COVID picked up very, very quickly, which a lot of people weren't expecting. For example, a lot of people were expecting COVID to last for multiple years and keep the economy down for a long time. And so all that printing ended up backfiring when demand came back way stronger than expected, and bolstered further by all this money that was printed. And so that's caused all this excess demand. And then based on supply and demand, the prices go up. And so the way you bring it down, the Fed is pretty much doing the opposite in terms of QT, kind of taking that money, the same money they put in, taking that out of the market. So if they do that for quite a few years, they could probably bring it back down to what it was before. Yep, QT over a long period of time, plus the interest rate hikes would probably cure it. Money printer went bird. Yep. Do we have any other questions regarding these topics? All right, so someone has asked, please share details on what to expect during the summer workshop. Yeah, so if you go to our website, which is investential.com/summer workshop, let me post this in the chat right now. If you go to that website, we have a full syllabus of what's covered. Let me actually paste that in the chat real quickly. And just to give you an overview, we cover pretty much all the investments. We cover, for example, we go into stocks, we go into bonds, commodities, real estate investment trusts, going into the depth of how all these investments work. We also look into different precious metals. We'll go deeper into I bonds and things like that. We also cover taxes, tax efficient investing, tax advantage accounts, 401ks, Roth IRAs, all of that stuff, as well as how to get started, how to open a brokerage account. If you're a minor, how do you invest as a minor? How do you open different investment accounts that work for minors, and things like that. And so the units we have are introduction, stocks in the stock market, analysis and modeling, index funds and other investments, accounts, brokers and trading, and taxes and tax efficient investing. So a link to the syllabus is right there. And yep, we record all the sessions. And so you'll have access to everything after the session's over. Also, a lot of what we do is interactive. So, less lecturing and more doing more exploring and stuff like that. So we'll also have things like a stock market simulator, different quizzes and tests to reinforce learning, and things like that. And everything we do is conducted through Microsoft Teams. So after you register, you'll get like a email and password to log in Microsoft Teams, and then you can join sessions, view assignments, and everything through there. So that syllabus and the link to register are in the chat. Do you have any other questions about the workshop or about any of the topics we covered today? Can we share this information about summer class to others in our friends and family circle? Yeah, for sure. That'd be great. If you think anybody else that you know would be interested, feel free to share that with others, get other people into it. Will you attend the HA convention or bring out flyers for a session? The session, it's actually happening next week. So it'll be before the convention. It's like every single day for the next of next week, we'll be having a 1.5 hour session. And at the end of the 7 days, we'll be done and we'll have covered all of our content. But unfortunately, I won't be attending the convention, mostly because I'll be going to Massachusetts the week after. So it'd be kind of tough to make it there in time. Yep, I appreciate all the compliments, guys. If you don't have any questions, feel free to leave. And thank you for attending.